Okay, so for those of you that are fairly new, and I think we have a few new agents on, I'm Bob Lovinger. I'm the president of FlexBuy. FlexBuy is a sister company of BCMS. Ali Razi is the CEO of BCMS, and him and I are partners in FlexBuy. FlexBuy's sole purpose is financing. So we work with businesses on two levels. One is that we help them by giving them a financing platform for their customers to help them expand their business. And the other thing is that we do is we also provide them with financing for their business. So, we're definitely B2B. We're there to support our clients. That's our sole focus. What I'm going to do today is, guys, I'm going to talk about our Credit Select Plus program, which is our core consumer financing program, and basically look under the hood. One of the things, and part of it is maybe a presentation issue, and that's all on me, is that we look at the Credit Select Plus program as one program, and it really is, but it's really made up of multiple lenders that are mixed and matched to make up a portal. So it becomes tricky because not every business is equal. Different verticals get different lenders. Different businesses within that vertical may get different lenders. So it's not just one program. We're not just out there giving one lender. There's other companies out there that are in this space, and in one way it's easier. They line up with one particular program. In many cases, it's our Easy Pay 360 program. They call it something else, but they'll bank on that one program, and they'll go out there, and that's all they're going to sell. So it's easier for them to go out there and promote that program because they can focus on that. The problem is, while I like that program, it's not suitable for every business, and it's not suitable for many businesses. That's why we have multiple solutions. We're not looking to fit square pegs into round holes. We're looking to get as close to a match as possible. It's not always perfect, but we look to get as close to a match as possible. So what I'm going to do first is I want to talk about a few different verticals that we have and basically show you how guys, if you can keep the background noise at a minimum. Like I said, if you're using a speakerphone, if you just joined us, please try not to use a speakerphone. It becomes it's suitable for background noise. So I'm gonna look at different verticals that we have, and show you how. And I'm going to put this together for you guys as marketing, for you guys to put together, your own proposals. But I'm just going to give you an idea of how we put these packages together and what a merchant can expect from the standpoint of lenders. So first thing I'm going to look at is auto repair. The four main categories, at least the four main categories that I view as the four main are auto repair, retail, home improvement, and medical. Now, obviously, there's a lot of sub-players even within those verticals, and there's a lot of other very strong verticals outside of those four. But those are the four main categories. If you were to start the business, today, and you're looking to not go against the grain, you're looking just to go with the flow. These are the four categories that are probably most aware of financing. They don't have to be convinced that financing is the way to go because many of them already have some kind of financing package. But those are the four categories. We do very well with other verticals in the service business and whatnot, but these are the four main ones. So I'm going to show you what we do with auto repair and just walk you through the process. Okay. Now we have many other lenders, and this is just what we can do, but we can mix and match. The first thing is our main prime program, and you guys have seen this on the Schedule A, and it will show the prime lenders is our program 14 and 11. There are two lenders that are direct to borrower, and they're very powerful lenders because they're direct to borrower. There's a lot of advantages to it that I'll talk about. It goes up to $30,000. The term is 36 months to 60 months. It's usually 36 months or 60 months. It's an easy online application process through our portal. So our portal is, basically it works like a waterfall. So the lenders are stacked up according to best credit down to worst credit criteria, and then as an application goes in, it basically goes to the top. If it's declined, goes to the next one, goes to the next one, until it comes out the bottom as a decline or gets approved. So we have many merchants set up, and Program 14 and 11 are the only lenders that they have. We can basically set up Program 14 and 11 with every single vertical. So every oddball vertical that you have out there, Program 14 and 11 will work because it's direct to borrower. As I said, 30,000, 36 to 60 months, easy online application process. The consumer APR will vary because it's a very broad credit score. To understand credit scoring, the top score is 850, the bottom score is 350. This program will approve everything down to about a 620 or 640 credit score. There's a lot in between there. So if somebody has an 800 credit score, they may get, I've seen actually 5.99% or 6.99% approvals. If somebody just squeezes in under the, under the bar, they may end up with a 29.9% APR. So there's a wide range, and that's what makes it a little bit difficult for some businesses to conceptualize, because it's such a broad range. It's hard to give consumers estimates. But it's the way to look at this is, if you have a merchant that just has, let's say, Wells Fargo or just has GE, sure, it may be more predictable. The rate's going to be 25 or 29 or whatever, whatever it is. They may throw a promotion in, but the range, the approval range from the credit score standpoint is much more narrow. They're looking for people with 700 credit scores and higher. So we can stop there too. We can give them programs that's all they get is 700 credit scores or higher. We're trying to build a platform that gives consumers options, and that's what this is about. As from a selling standpoint, right? It's about giving businesses something more to talk about. If they don't offer any financing, and you're an auto repair shop, it's going to be cash or credit card. Those are really the only two viable ways that people can pay. If they don't have the money to do that work, there's nothing else to talk about unless the auto repair shop wants to take on an accounts receivable, work out some kind of in-house financing. So what we're doing is we're providing these businesses with a tool to further the conversation. If it ultimately becomes a decline, they're no worse off than they were before, right? They're in the exact same boat that they were before that. If they get an approval, now they have a customer that they otherwise wouldn't have had. The in between is what happens if they get an approval that the customer doesn't like. If they get an approval that the customer doesn't like, also they're no worse off than they were before. The customer could always say no, but the customer can't say yes if nothing's being offered to them. So that's the way financing has to be looked at. Okay. The discount on this program 14 and 11 is very, very attractive. It's 4.9% discount all the way down to, like I said, the 640, 620 credit score. The borrower closing cost, this is something that's unique to these lenders. They'll charge a 1 to 5% closing cost off on the borrower side. Guys, I'm going to have to mute you guys out if I can't get this noise under control. It's just very annoying. So please just keep the background noise, to a minimum. So Program 14 and Program 11 are very, very powerful lenders. They come as a bunch. So if we're setting up a merchant, we're going to set them up with both, because 14 is usually in the first position. They'll usually cut off at about a 650 credit score. Program 11 will go a little bit deeper. So the question was asked about downloading these sheets. These sheets are not available in the back office yet. They will be this week as soon as I fine-tune them. So Program 14 and 11 is the base that we can set up every business. The pro of it is that it's very flexible. It's very flexible programs. The con is that some businesses get a little bit skittish about the direct-to-borrower aspect of it. Because here's, theoretically, the money goes to the borrower, and then the borrower has to turn the money over to the business. Knock on wood, I have never had an instance yet where a business has told me the customer got funded and they didn't get their money. So it hasn't happened yet. It can happen, and I'm certain that it will happen, but it hasn't happened. So, it can be a fear. We have to dispel that fear some of the time. Some businesses don't care. They understand this for being what it is, and there's tremendous advantages to it. Also, I'm going to be altering the process a bit to make it a little bit less risky for the merchant. We're going to get more involved in the transfer of the money. So I'm still working on that. I was hoping to have it done by now, but that will be done in the next in the next week or two. I will have a new system in place that will be more involved in the transferring of the funds, so it will make it a lot safer for the consumer. The other thing about Program 14 and 11, because it's direct to borrower, the borrower may be offered amounts other than what they applied for. So let's say they applied for $2,000. Let's say they applied for $2,000. If they're qualified and eligible, they may be offered $5,000, $10,000, $3,000, different amounts that they can take, and the merchant doesn't care, because if the borrower decides, I'm going to take more money and use this extra money to do whatever, or I'm going to buy something more than I intended with this merchant, because maybe there's an upsell, maybe there's something else they could have done that they were holding off on, but now that they have more money available, they're going to use those funds to upsell. So for the merchant, it doesn't make a difference. By the way, as far as the discount is concerned, the merchant only pays on the amount that they need. So if a borrower does take a higher amount of money, if they apply for $2,000 and end up taking $5,000, we only collect the 4.9% from the merchant. We don't collect on the $2,000. We don't collect on the $5,000. So this is a very, very powerful program, and you'll see in the area of home improvement, it's particularly powerful because many of the lenders, and as far as I know, most of the lenders that pay the merchant directly need to wait until the work is done before they'll actually fund the money. With these programs, the money goes to the borrower, so the merchant can wait until they get the money to actually produce the service. So that's the core program, and I'm going to spend a lot more detail because a lot of them, just about every vertical has 14 and 11. So 14 and 11 is a great core program for many of these verticals. We use it. It's great for oddball businesses that are outside of the norm. It's also good for new businesses that maybe can't get approved for other programs, because the thing that you need to understand is, and this is the main purpose of this webinar, is even though this is one platform, each lender has their own criteria. So some of the lenders, ask for tax returns. Some of the lenders ask for a certain amount of revenue. Some of the lenders need a certain amount of time in business. So there's not just one mind out there as far as the lenders are concerned. Now, the question is always asked of me of why do the lenders care? Because the money's it's a loan between a consumer and a lender. So why do they care about the business? There's a huge concern. Okay, first of all, these lenders have different metrics, and they'll tell you their metrics. Different verticals produce different default rates than others. So there are some businesses that are notorious for, high defaults, and they'll tell you which ones they are. I mean, that's why, and we see it on our end, because we'll see businesses, we'll see lenders cut out. They'll say, I no longer want jewelry stores, or I no longer want cell phones, or I no longer want transmission shops. So there's different verticals have different default rates, and that's why the lenders care. The other thing they care about is the business itself. So even though it's a transaction between a consumer and a lender, the probability of a consumer paying back is really still tied to that business. So, a lender will tell you that if John Smith is doing business with ABC Auto Repair and ABC Auto Repair goes out of business, let's say, 2 weeks later or a month later, and it's happened, there's less likely in John Smith's mind, he sees that as an opportunity not to make the payments. Not all the time, but some of the time. So there is a correlation between the business viability and the consumer making the payments. So there is a strong tie. The businesses that are funded directly from the merchants, particularly, do want to know about those businesses. Okay, because the money's going to them, they do want to know about those businesses, and they do care about those businesses. Now, the second program here, and this is one we use, whenever we can. It's more difficult because you can see they ask for 2 years of tax returns for corporations. Not, and as we know, not all businesses like to give information. Guys,
on my topic.
Guys, all right, I'm going to have to mute everybody, I'm afraid. Let's see if I can do that.
Thank you.
All right, guys, so I just muted everyone. If you don't hear me, just please, send me a message or whatever, but I can't hear you now, so I don't know what's going on in the background. So the second program, Program 9, is one we give whenever we possibly can. They do ask for more information. The advantage of Program 9 is that it's first of all, it goes deeper as far as credit goes. They'll go down to about a 600, 590 credit score. It's a revolving line of credit. So if you're dealing with a business, they'll basically be able to, they'll always get approved for the amount that they qualify for, which is, most cases they'll approve for $10,000. So even if they only need $1,000 or $2,000, they'll have the availability of additional funds. It's not the cheapest program on the market for the consumer, but it is more predictable. The APR fluctuates between 25 and 29% for most. It's not as easy to capture this program in a small spot like this because they do have different tiers for different business types. So, as each business type, the program varies slightly. So I'm just giving you a generalization. From a credit tier standpoint, they break it down into 3 credit tiers, from prime down to low. So the discount to the merchant will be 5%, 10%, or 20%. For those of you that are new and are not familiar with discounts, here's the way to look at a discount. Let's say you have a $1,000 transaction, okay, that a merchant is putting in for. If it comes back as a 10% discount, the consumer, the borrower, is going to be approved for $1,000, but the merchant is only going to receive $900 of it. It's going to be a 10% discount. A 10% will be taken off the top. That's the discount is the merchant's portion of the risk, right? So there's 2 profit centers for these lenders, and every lender has discounts that deals in this space. The one profit center is the APR. The second profit center is the discount. That's the merchant contribution as far as the risk goes. So obviously, the worse the credit, the higher that the lender views this is being risk. So the merchant has to pay more into it. Now, savvy merchants will adjust their pricing accordingly, and we can help merchants do that. So there's legal ways to do that, to adjust the pricing, to adjust for anticipated discounts. Now, you can't always do it, especially if it's on a sliding scale, but you can basically, as a business, say to yourself, all right, I'm going to adjust for up to 20% of the discount, and I'm going to build that into my price structure. Now, if a discount comes in at a higher level than what they anticipate, a business always has to ask themselves, is part of a transaction better than no transaction at all? So, some business models, some business verticals just don't have it. Like if you talk to an HVAC company, they may say they're only dealing with a 15 or 20% profit margin. It's very, very narrow. So they can't obviously afford a 20% discount unless it's built into the price. Other business models, you're looking in the retail space, the profit margins are very high, and they can easily absorb the discounts because they have so much profit built in. So, businesses have to ask themselves whether it's viable, and also what's the cost of not taking on a customer. You spent the money on advertising, marketing to get a customer, goodwill, whatever you did to get that customer through your doors or on the phone or wherever you're doing business. If you turn them away, that's wasted money. You've made zero off of those costs. So, I try to point out to businesses that, they got to look at the big picture. Not every customer is going to be financed. Not every customer is going to have a high discount. but it may behoove them to basically take those customers because of, you're basically paying yourself back off your marketing costs. Also, how about the referrals that it leads to? I mean, if you look at your business model, maybe they say, all right, hey, 50% of our business comes from people telling other people about us. So, if you turn that person away, that's one less branch in that tree. So there's a lot of ramifications as far as turning people away. So that's what financing does. Financing basically, besides a practical, besides as a practical tool of adding business, it's also a marketing tool. It's a goodwill tool. It basically shows your prospective customers that that you care about them. So as I said, this program 9 is strong. It just brings you a little bit deeper. It gives the merchant the opportunity also of putting together promotions, 0%, 6 months, 0%, 12 months. It's something that is a great hook. Businesses that utilize it, will advertise it, put it in their window, do whatever they can. The truth of the matter with these 0% promotions, most people that are lured in by those promotions believe that they're going to pay off the loan within that time period. The truth is that very few people do. Now, these promotions, and this is true across the board, no matter who the lender, it's not 0% for 6 months, 0% for 12 months. It's 0% if 6 months or 0% if 12 months. That means if a consumer pays off a loan in that window, in that 6-month window, they're going to end up paying 0% interest. If they go a day beyond that window, the interest is accrued from day one. So it's not a period of time where they're not paying interest. It's a period of time where they have the opportunity to pay off that loan without paying interest. All right. So it's very important as far as a distinction is concerned. This last program that we're putting into the auto repair spectrum, and I have other programs. I'm just trying to simplify it. There's crossovers. There's programs that fill the gaps. But this last program is only available in certain states, and this is a very subprime program. It's subprime in every way. It's very expensive for the consumers, assuming they go beyond the 90. If they go beyond the 90 days, it becomes very expensive for the consumers. The discount is very affordable. The APR is astronomical. I mean, the APR is 183% at the worst case tier. So they have 5 different tiers. So it gets more expensive the worse the credit, and most of the time the consumers that use this need it. They'll go down to about a 500 credit score. Income is not as important with these other programs, and most of our programs is the debt-to-income ratio of 45%. That means that the total debt, including the new loan that they're taking out, cannot exceed 45% of their gross income. So that kicks people out too. We'll get calls all the time. Hey, this person, we just put in someone that has a 680 credit score. How come they were turned down? And you look at the application, and they're making $1,200 a month, and they just don't, they just can't carry the loan. So it's not just pure credit. It's also based on the debt to income ratio. So this program, the minimum income is $1,000 a month. That's basically what they go by. It works very well for certain merchants, not so well for others. Not included in this outline for auto repair is, for those of you that want to sell the Easy Pay 360, that's a great option for auto repair businesses as well. I'm not going to go into that. There's other training in our training center on the Easy Pay 360, and I'll be doing them again in the future. But Easy Pay 360 is a great option for the auto repair sector. Also for businesses that are primarily tires and rims. So you have the tire shops that are out there. We can also put them into no credit check lease purchase programs. So I'm not going to go deeply into those, during this training. I'm just going to touch upon it. But no credit check lease purchase programs, basically, just like it says, it's no credit check. The consumer leases it, and then there's usually a buyout at the end. The approval rates are very, very high. They work very well in retail, those programs. But it's most of the lenders we have in this space want the business to be primarily tires and rims. Then they obviously don't trust the merchant. If it's an auto repair shop, to just use it for their tires and rims. So that's a consideration. So this is on the auto repair side. I'm going to go through some of the other verticals I picked out. Let's look at the home improvement. Home improvement, in my opinion, is a great vertical. It's there's a lot of businesses out there, that fit into home improvements. There's a lot of mom and pop businesses, which is great for us because we can set up just about everybody. We have about 4 lenders in the home improvement space that we can set up for just about anybody. So any home improvement business, we can set up with 4 different lenders out there. And how we set them up in the waterfall really depends on the merchant. We have the program 14 and 11. I'm not going to go deeper into that, but that's great for home improvement. The reason it's very good for home improvement is the money is directly funded to the borrower. So especially for those smaller home improvement companies, they don't have to wait for the money. The borrower gets the money, and then they can basically pay the merchant. A lot of the small businesses don't have the resources to put out the work first, and then get paid. Some of the bigger ones do, but a lot of the smaller ones just don't have it. The bigger ones usually may have a line of credit to buy them, to buy the materials that they need. The next program we have is a new one you haven't seen. It's Program 22. Program 22 is a direct-to-merchant funding, good for amounts up to $30,000. That's for those merchants, those businesses that want to offer those 0%, 6 and 12-month a promotion. It goes down to a similar credit score of Program 14 and 11. So the big plus for this program will be that it does allow them to offer those kind of promotions, and also the terms are longer. So for those people that need longer terms, Program 14 and Program 22 works very, very well. There's a lot of documentation required from the business, so the business is this is more for the established business. Program 9 we spoke about. It also works for home improvement. Program 1 is a great program. It's a Title I lender. So with Program 1, we can go up to $100,000. The discounts are very, very competitive. The credit score goes down to 650. The great thing about this program, and I didn't put it in here, and I probably should. The term goes up to 20 years. So it can go 10 or 20 years depending on the loan amount. Now, because it's Title I, there's a lien put on the property, but there's no appraisal required and there's no equity required. So as long as the homeowner is willing to allow a lien on the property, this loan works very, very well. It's a very solid, and most home improvement businesses want us to set them up with this program. Program 1 is a very, very solid program. There is a closing cost to the borrower because it's not a mortgage, but there are there is a recording. There are other there is additional paperwork that goes beyond just a typical consumer loan. And then finally, in the home improvement, and we have many other lenders in home improvement. I'm just trying to pick out the ones that represent, where most of our merchants are going to fit. So we can always mix and match. If one doesn't work, we have other programs as well. Finally, we have a subprime lender that will go down to about a 600. 590 credit score, right around there as well. Program 18, it's totally a subprime. The APR will vary. It's an easy online application. It's part of our portal, as are all these lenders that are here for home improvement. So it's all part of the waterfall. The discounts could be very high, up to 35% if somebody is at the bottom of the spectrum. The funds go directly to the merchant. And by the way, on the Title I program, Program 1, the funds go directly to the borrower with that program, but the borrower could only use the money with that merchant. So it's very specific money. They have to turn it over, but it can only be used with that merchant. The reason they do it that way, and this is the thing that's really becomes a sticking point in the home improvement sector. With the lenders that fund the merchant directly, they'll usually ask for the consumer basically to sign off on the job. So basically the consumer has to say, yes, the work was done, and yes, it's satisfactory to us. So that's the element that remains with Program 1. They still have to go through that, and they go through that by basically turning over the money. So if they're not happy with the job, they don't turn over the money, I guess, or the consumer or the merchant works out something with the consumer where it's paid over stages, as most home improvement jobs are done that do not include financing. By the way, Program 9 in the home improvement sector, because it's a revolving, the consumer gets access to the money before the job is done. So it's, we've set up a very, very aggressive and a very, very flexible platform for home improvement. Now, we can go lower. We have a couple lenders that may go a little bit lower on the credit score. I don't feel it's all that important in the home improvement sector, because you would have to think that somebody that is doing improvements to their home is at that stage where their finances should be stable and hopefully their credit is stable. So we find that most of the time going down to 600, maybe a drop lower, should suffice. And if somebody is beyond that, they may want to question why they're doing the work in the first place or whether the work makes sense. By the way, I know there's been a bunch of questions. I'll try to answer them all at the end. Just keep on writing your questions in the notes, and I'll address all the questions at the end. So that's on the home improvement side. Let me talk about the medical. So those of you that have been out there and going out there and promoting medical, obviously the elephant in the room is Care Credit. Just about every medical provider offers Care Credit, and that's what they've gotten used to. They may have had it for years. It's pretty hands off for them as far as the application process. Here's the thing that you need to understand from the standpoint of medical and the standpoint of Care Credit. Now, often you'll go in and you'll speak to a dentist or a doctor, and you'll say, well, what's your decline rate on Care Credit? And they'll say, 30%. I guarantee you the amount of business that they're losing is far greater than 30%. Here's the reason. Often, what the medical practice will do is basically just hand a brochure over to the consumer. The consumer goes home, does the application, they get turned down, and they don't come back. They don't have a wherewithal, especially when you're talking about elective surgery, something where there's a choice. They don't come back, so they never hear from that patient again. They don't know why. It could be because they're turned down. Second, a lot of people have already used Care Credit. That maybe they already have an outstanding Care Credit loan. Care Credit will not approve another loan with as long as one is still outstanding. So that takes a lot of people out of the marketplace. So you have to. So there's multifacets to this to why medical providers need us, whether it's in addition to Care Credit or whether it's instead of Care Credit. Either way, there's a role for us, okay? So we have Program 20, which is our near prime to near prime lender. This program matches up, head to head with Care Credit, pricing-wise, everything about it, except that it goes down to a 600 credit score. So where Care Credit will stop at 700, maybe they'll touch 680 on occasion. This program will go down to a 600 credit score, and from a pricing standpoint, is very, very competitive with Care Credit. So this is a program that we can go in there for those businesses that say, I'm willing to try someone instead of Care Credit. The thing about Program 20, it's not part of our portal. So if a medical provider signs up with Program 20, it has its own application. They'll use that for the prime customers, the people they think are prime customers. If they're declined, then they'll come over to our own platform and then do the application there. So, Program 20 is great as an alternative to Care Credit. They'll approve more at better rates than Care Credit and go down, like I said, go down to a lower credit score. Everything about it is very favorable. They go up to $25,000. They're mostly looking for cosmetic surgery, elective surgery, that kind of stuff, dental, LASIK. This is not someone you'll use for chiropractors. By the way, veterinarians are totally different. I mean, some of our lenders we can use veterinarians with, others we can't. This one, Program 20, we cannot. So there's, most medical providers will fit into Program 20. Program 9 I've spoken about. That's a great alternative for that goes a little bit lower than Program 20. It's also, it's an alternative. It's also a line of credit, so that's favorable as well. That's in our portal. Then we can also give them our base, Program 14 and 11. That's also viable as well. And we have other programs as well, depending on what the needs are. So the point is with medical and really with all these verticals, we're a problem solver. All right. So while we're offering them one solution, there's a lot of different elements to what it is that we offer. So we go in there and we'll mix and match the programs accordingly, depending on what their needs are. I don't think they're going to find as diverse a program as we have. I mean, we have a lot of different solutions. Our platform is very broad. I'm just showing you the tip of the iceberg just to give you an idea. There's other lenders out there that I have not shown you because either they're very specialized, they maybe it's only operate in certain verticals, or maybe there's an overlap where I didn't feel that we have to present them right away. But, we may want to present them if there's a stumbling block, if there's for some reason, one of our lenders does not like one of our merchants does not like the lender we set up with, or doesn't want to provide the documentation. Okay. All right. So then let me just talk about retail. Retail has become the diciest of our main verticals, and the reason is, it's been out there in the financing world the longest. So there's a lot of established lenders in the space. Also, there's a lot of verticals that have gotten beat up lately. I mean, there's a lot of lenders that are stepping away from jewelry, that are stepping away from the cell phone business because there's so many defaults. There's a lot of the main lenders that have been in this space, and they've been in this space for a long time, is the lease purchase program. So, Progressive, for instance, Progressive Finance has been out there in this space for many, many years, and it's a lease to own program. It's very expensive, as is our lease purchase programs. But the advantage of it is that historically has been relatively easy to get approvals through. Now, lately, I've been hearing from merchants that Progressive has tightened up. They're shortchanging a lot of customers, not approving the full amount. They've been slow to pay. So there's some opportunity there. The other thing with Progressive is that they've been out there for so long that a lot of people already have a Progressive loan, and they will not give a loan to someone that already has an outstanding Progressive loan. So a lot of these retailers are looking for alternatives. Now, in the credit lending space, we just last week lost one of our biggest players. We had a lender that went down to 500 credit score, and they've done this in the past. And they'll basically focus on different verticals depending on where their interests are at any given time. So, for instance, they had decided a while back that furniture was very risky for them. Now, furniture is a risky business. Those of you in the credit card space know that furniture is considered one of the riskier businesses to set up for credit cards. The reason is people often are unsatisfied with the furniture once they get it home. There's, it's dinged, it's damaged. Same thing happens in the lending space. So that lender had increased furniture to only stores that do a minimum of $2 million and higher. So this past week or so, they basically said we only want businesses that do $10 million and higher on all our businesses. So we basically eliminated them from our menu, and it was a big hit. It was one of our big retail lenders, especially in the subprime space. But we do have alternatives. So for the prime to near prime customers, we can go out there and compete with GE, compete with Wells Fargo with that Program 20. It goes up to $25,000. Very, very competitive on pricing for those people with credit scores of 600 and higher. Once again, it's its own portal. So for people, for those merchants, they'd have to go to that lender's portal, put the application in. If If it gets approved, great. They run it through the through that portal. If it gets declined, they'd have to come to our portal. I next have program 14 and 11. Now, these lenders, I haven't pushed very hard in the retail space because the transaction becomes clumsy because it's direct to borrower. It becomes an issue because in the retail space, retailers like to finish the transaction right away while the person is in the store. They want instant decisions. They don't want any conditions. This program does not provide it. So 14 and 11, a lot of retailers don't like it because you may get a pre-approval, but it may be hard to get the instant. There's other steps to the approval process, so they may not get an instant decision. It works in some verticals and not as well in other retail verticals. I put it in there because I think with the changes I'm going to make to the steps to the funding, it may become more suitable for other retailers. So I'm leaving it in there for now. It has to come with an explanation. It's going to be a hard sell as it is to retail businesses, but it's there, and I'm going to try to make it as powerful as it possibly can be. We then have Program 9, which I spoke about. It's a revolving credit. It brings them a little bit deeper as far as credit score, and there's other advantages to it. It's also part of our portal, so they'll do instant decisions. And then we have that Program 6 that I spoke about earlier. That's only good in these states. That's good if you're in these states or selling in these states. It's a powerful retail program. I know we have one of the agents on the call now that has a few merchants set up with this lender, and they're doing high volume. So this lender is capable of doing some high volume, especially a little bit off the beaten path type of verticals. And we also have a menu. We also have our own no credit check lease purchase program. So for those merchants that only have a Progressive or maybe one of the other main lenders in that space, we can provide them with other lenders or competing lenders. I think our lenders will do a better job than Progressive based on what I've been hearing. So, we still have a full menu for the retail businesses. It's not quite as full as it was prior to last week, and we're always looking to fill in. And that's one of the reasons, an earlier decision that I made was not to be so transparent as far as the lenders are concerned. I'm really hesitant even doing it now because you set up these merchants with a preconceived notion as far as what they're getting, and then if we have to, for some reason, we lose a lender or they're turned down by a lender, sometimes it's hard to backtrack. So I'd like to go with more general descriptions of who the lenders are. I feel pretty safe and pretty good about showing you the lenders I've shown you because they have been pretty stable. So we always reserve the right to change. We always reserve the right to swap out a lender and put in another. Or these lenders always come with underwriting. So it's possible that a merchant can be turned down for a specific lender. But here's the thing as far as, it all comes down to selling, right? So you're going in there, and I'll mention this in every single training call that I have. You're going in there and you're offering these merchants options. That's what financing is about, right? So those of you that have been in the credit card space, and if you ask Ali Razi to tell his story of how he built BCMS, he'll probably tell you when he started the business, not everybody had credit card processing. So it was about convincing businesses they need credit card processing. Why should they? They're doing fine, and all they're doing, they're just taking cash. So you have to convince them of why credit card processing made sense. It wasn't until credit cards became more widespread where all of a sudden businesses said, you know what, I'm missing out on these people that only want to pay with credit cards, that don't want to walk around with a wad of cash in their pocket. So it became, in one hand, an easier, in every respect, an easier sell because now it was established that people needed credit cards. Now it's gone the other way where everybody needs credit cards, and now they're shopping like crazy, and they're basically looking to save a nickel every chance they get. consumer financing is at that stage where credit card processing was, where in many cases you still have to convince a merchant as to why they need why they need consumer financing, and it basically comes down to the options. If you don't have anything to offer them beyond what you currently do, the conversation is over. So if you're only taking cash and credit cards, and that's all you're offering, if they don't have that money to put the deal together, they're walking away. I mean, that's basically it. The other thing financing does is, and I forget the number. I'm getting a little old, so I used to know this number. GE did a very big study on the effects of consumer financing. People that use consumer financing spend considerably more than people that using their own resources. Why? Even those people that are using credit cards, there is a limit on their credit limits. They don't want to exhaust their credit limits. With financing, it's its own standalone payment solution. So people will spend more. They'll upsell. If it's an auto repair shop, they'll get more fixed. Maybe they won't wait on something. If it's a retail, they'll buy the next step up. So if it's medical, they'll do an extra procedure. Whatever it is, people will spend more and do more when financing is involved. So businesses really, by not offering financing, are leaving a lot of money on the table. Now, the way not to sell consumer financing is you don't go in there and sell them on this is going to solve all your problems. There's no financing solution that will approve 100% of the applications. Even the no credit check lease purchase programs. Now think about this. The no credit check lease, they're not pulling credit report. The income is not that important. I mean, you basically put, at least the lenders we have, they're not even asking for pay stubs. So it's basically, it's based on one thing. Do you have a checking account? And we have a lender now in the lease program that doesn't even require a checking account. And if we do a quick background check, they have algorithms. Do you show up as being a citizen? Have you lived in the same place? Can we find you? And even still there, you're only going to get 80% approvals, maybe 90% approvals. So there's always going to be turnedowns. We can't solve it. We can't make those go away. The way to look at financing is everybody you finance, whether you can have a successful financing program and only approve 10% of the applicants, because those businesses that are smart understand that those 10% are people they otherwise would not have had. Financing cannot hurt, right? If somebody's turned down for financing, you're back to having the same conversation that you would have had with the customer if you never had financing in the first place. Do you know anybody that can give you the money? Blah blah blah. They can go through every option they had before. If they have financing, that's a new customer. The other thing is financing brings people to the table, brings people to the business, right? So the businesses that are smart will put the signs in the window. They'll advertise. If they're advertising, they'll talk about their financing. They'll make mention of it. There are people out there, a lot of people, that will come to a business only because they have financing. It's not because they have the best price. It's not because they have the best reputation. It's because they're marketing that they have a solution for them to become a customer. Now, if there's 10 businesses in that space, if you're one of 10 furniture stores, let's say, and this old furniture stores now just about have financing, but let's say they didn't, and you're the only one that has financing and the other 9 don't. If you need financing, you don't care about the other 9. They could have the best pricing in town, but you still can't make it happen. You're going to be drawn to that one business. Now, even if the financing is turned down, you're still having, as a business owner, you're having a conversation with a prospect you never would have had the opportunity to speak to. Or maybe you would have had, but you would have been, you would have had a 1 in 10 chance of having that opportunity. So you could still make that same appeal, still get them emotionally sold into the products that you're selling, the services that you're selling. You still have that opportunity to make the sale. Financing is tremendous. We have businesses that never put through loans but still keep on paying the subscription fee. I'm not happy about it because, let's face it, the way we make money is by getting these merchants to use the program, and that's going to be another training session of how to get that to happen, because sometimes we have to continue to work with them to get them used to offering this financing and getting them to use it, because really that's how you can, that's how you make the money in this business. It's not through the setup fees. It's not through the, the small money you may be making through the subscription. We have to get them to use the program. But we have businesses that don't use the program and keep on paying the subscription fee because they're utilizing the financing as a hook. So once they get them in, they may never do financing, or they may convince them of something else, but they're still using the financing as a hook. Financing is tremendously powerful, and I just want to show you what's involved in putting this together. So from a sales standpoint, here's what's important: to understand that we have multiple solutions even within our platform, and also to prep them for the idea that they may have to work a little harder to get some of these lenders, but they should get excited about these lenders, right? So, those of you that have done proposal requests recently may notice that I'm starting to lay out the programs like this. I want to show the merchants what programs we have, because it's really hard to provide a snapshot, just in one Schedule A, because it really describes multiple lenders. So we want to get them excited about this, and we also need to let them know there may be additional steps to get them approved with some of these lenders. Now, if you're just selling program 14 and 11, or some of the other, like in the home improvement space, that don't need any additional information besides the enrollment package, that's fine. If they can live with just program 14 and 11, and I personally have had conversations with businesses about this. I said, you know what? Let's start with program 14 and 11. We'll learn about who your customers are. We'll learn about your demographics. Let's see. We may find that it's doing the job for you. We may find that you're getting no one approved, and then we can work at getting additional lenders set up. But you know what? It's a great way of testing out your market. This is not just a set up and go type of product. This is kind of, we hold the merchant's hand and we have to learn about what their experience is so we can make the proper adjustments. Hopefully it's a partnership of more than just, I've had merchants quit because they put 2 applications in and they were both turned down. And my answer is, I doubt whether 2 was actually a test. I don't think, statistically you can ever, prove that 2 applications is ever a test. And the other thing is, sometimes we may be able to add, we may be able to add to the mix to improve it, depending on what's happening. And I'll look at those 2 applications and I'll see, well, they had a 480 credit score. Believe it or not, I've seen a lot of credit scores below 500. No lender's going to help them with that. If I see that they have people that are in 600 and 610 and they're just missing out, we may be able to help them with additional lenders if they qualify. So this is a work in progress. It's something that, as a salesperson, you don't need to be overly involved, but you should be involved to the point of encouraging your merchants to work with our system. It pays off. Believe me, I've had merchants that have done over $100,000 a month in financing. They're out there. You guys can find those merchants, and sometimes they're not there when you start. You have to show them. You have to convince them. You can make a lot of money in this business, and you don't need a ton of accounts. Now you want to build that base, right? You want to build, because just like in credit card processing, those of you that are in credit card processing, the majority are not going to be the big businesses. So you want to build that solid base of those businesses that are just feeding you a little bit, and then you incorporate those businesses that are doing high volume, and that really makes it happen. So you just have to get out there and start promoting this and start making it for what it is. It's not about the financing. It's about the outcome. It's about what it does. It's not about, because all things being equal, businesses would like to make their life as simple as possible. They'd rather not have to have a credit card terminal. Would rather not have financing. But you know what? Let's face it. They need them. They need them all. It's part of the process. It's part of their evolution. If they don't do it, they're going to lose out. Let me see what questions I have, guys, and then I'll open it up, and let's try unmuting you and. All right, so I'm going to try to answer some questions here. All right, I said these sheets are not available in the back office yet. I'm going to fine tune them and then get them back there. Is that borrower cost taken out prior to putting money in their account? The closing costs are taken out before the money goes into the consumer's account. So the merchant and the consumer need to take into account the closing costs, and it is disclosed to them. So the way it works is, let me show you what the back office looks like a little bit, and show you what a consumer will see. All right, so this is the back office, guys. So let's look at the funded at a funded loan from one of our merchants that just funded, I think, last week. So in this case, as you can see, well, the application was for $10,000. So this consumer was applied. They were given offers with Program 14, so they have a decent credit score. They were given offers from everything from $8,000 to $25,000, 36 months and 60 months. The APR is a little bit on the high side, so my guess is their credit score was somewhere in the 650, 660 range. They must have strong income. So you could see here the one they picked was $8,000 loan amount. The payout, so that's after the closing cost is $76.81. It was funded, and that's the amount they accepted. So they didn't even go for the amount that, it's possible the merchant put in for a higher amount, anticipating these additional costs. But ultimately, the way it works is once the consumer put this application in, they got an instant decision. This was emailed to them, so they were emailed, and they usually look at their smartphone. They will email these offers, and they get to pick which one that they want. So once they clicked, I'll accept this offer for $8,000, it takes them to the contract. They can sign the contract online. There's no wet signature required. They can do everything online, and then they're given instructions of how to proceed with the pay. They need to provide a pay stub. Usually, that's usually one of the steps. They're told how to make that happen. Once that happens, the approval is finalized, and the last step is the bank account is verified. So if you've ever gone through a PayPal application, they do it the same way. They'll deposit two small amounts into the person's bank account. The person has to go check those amounts, go log back in, enter those amounts, and it verifies, and then the money goes right into their account. So this is the way it's presented to the consumer. There's no surprises. They know exactly what it is that they're getting. What if a customer does not come back? I think I went over that. I mean, it hasn't happened yet. What we usually in training, what I'll usually mention to a customer with these programs, 14 and 11, as soon as you get the pre-approval, take a deposit, take a down payment. It's not out of the ordinary. Even the smallest down payment will take the customer off the market. They're not going to shop it. They're going to come back. And so I tell most of them to take a deposit. I'm going to be setting up procedures that hopefully will alleviate even some of that fear. But it's really so far an unfounded fear. As I said, it probably will happen, but it hasn't happened yet, and I don't anticipate it. Does the borrower closing costs all go to the lender? No. The closing costs, we don't make any money on the closing costs. So the closing cost, that's not part of our profit center. That all comes off the top. What about the borrower? If the cost is 5% with a lender deposit $950 into their account? Yes, the final amount of that's being paid out to the consumer is after the closing cost. For the direct to borrower lender, what about the okay? Can you set up home-based businesses? Yes, with program 14 and 11, or even on the home improvement side, we can set up home-based. Basically, we can set up any business as long as they have a business license. As long as they're really a business, we ask for void a check and a business license. As long as they're a real business, we can set them up. Let's see. Does the program charge up to 9.99 to business as well as 10% to the customer? Yes. So there's two parts to it. With the Title I, I think that was a reference to the Title I program. There's two parts to it. One is the discount to the merchant. The other one is the closing cost to the customer. Similar to similar to, if you do mortgage loans, it comes with points. So, every loan has a way of chopping out the risks. The 10% is not all points. The 10% is not all discount or points to the customer. A lot of it is recording documents and other things that go along with just because it's a secured loan, and that's only for the Title I program. That's all the questions. Do you guys have any other questions?